Hello, my name is Ramnik and this is my video application to IE Business School for the Masters in Finance. I'm going to provide my opinion on the greatest challenges in the financial service industry. But before we can address these challenges, we need to fully understand the climate of this industry. For this, we need to go back to 2008, the year that is seen as the beginning of the credit crisis. In a traditional economy, we have lenders who have a financial surplus and we have borrowers who have a financial deficit. Both are connected through the financial system. Now let's have a deeper look into the lender. The lender wants to turn his money into more money through investing. But of course he has his conditions. He wants a decent return on investment and he wants the investment to be safe. In the period leading up to the financial crisis, the lender went to the Federal Reserve where he bought treasury bills. These were seen as the safest investment since no one thought that the US government could go bankrupt and they gave a high return on investment. So what happened next? 2001 was a year characterized by a global slowdown of economies, lower investment spending by businesses, along with the dot-com bubble burst and the 9/11 terrorist attacks. The world economies were suffering. What was the reaction? Alan Greenspan, chairman of the Federal Reserve, lowered interest rates to 1%. This has a double impact. On one hand, lenders are unhappy with the 1% and are searching for a new investment. On the other hand, borrowers are very happy with the 1% since it meant cheap credit. This cheap credit gave the investment banker an idea. His idea was to connect the households to the investors through mortgages. This is how it works. When households want to buy a house, they go to a mortgage broker. Of course, there are some conditions. First of all, the households are required to give a down payment, and second of all, they have to provide a proof of income. The mortgage broker would then go to a mortgage lender, for example a bank, and the households were connected to the mortgage lender through mortgages. Now the idea of the investment banker was to buy all these mortgages, of course by leveraging the deals, and put them inside one big box called a CDO, collateralized debt obligation. The CDO was then split into three parts by the investment banker called tranches. The first tranche was a safe one, the second one was okay, and the third one was risky. So households were paying off their mortgages, filling the box of the collateralized debt obligation with money. The investment banker would then split it into three parts and sell each part to investors, hedge funds, and other banks. This system was so profitable that there was a rising demand of CDOs. The problem, however, was that there were no mortgages left to put inside the CDO. So the broker, investment banker, and lender came up with an idea. The idea was that households were no longer required to provide a down payment nor a proof of income. These are called subprime mortgages. This enabled more households to buy houses, resulting in more mortgages to put inside the box. The whole financial system was making tons of money. So households were paying off their mortgages, filling the box of the CDO with money. However, we have to keep in mind that some of these households were not even able to afford these houses. They weren't required to provide anything. Let's examine the effect if one household defaults, stops paying their mortgage. Imagine a street with 4 houses all worth $100,000. If one family stops paying their mortgage, their house is put out for sale. This was not really a problem since the US housing prices were rising. However, if a second house is put out for sale, the price would drop down to $80,000 due to the forces of supply and demand. Additionally, households that were paying their mortgage of a house worth $100,000 now only possessed a house worth $60,000. Scared that the price would go down even more, they also rushed to sell their house. So the supply of houses was high and the demand was low, pushing the prices down big time. The impact was that the CDO was not getting filled and the housing market bubble bursted. If we go back to the system, we can see that first of all there were no mortgages to put inside the CDO. Second of all, no one was buying houses, making the broker lose his job. And last but not least, everyone was selling their CDOs, making the whole system collapse. This marks, in a very simplified manner, the start of the credit crisis. As we have just seen, the impact of the credit crisis was severe and was to be felt throughout the globe. Questionable practices along with greed and misconduct caused a recession not only in the United States but in the whole world. People lost their jobs, their savings, and even their homes. But most of all, they felt betrayed by the financial system. Change had to come for the whole financial system to survive. Change, however, comes with several challenges. In my opinion, the most dominant challenges facing the financial service industry nowadays are a direct result from the credit crisis. The first challenge is to win back the public trust. The second challenge is to work under tighter regulation. And the third challenge is what I like to call the unknown. The first challenge is to win back the public trust. In the pre-crisis period, no one would have imagined a financial institution to go bankrupt. Fannie Mae, Freddie Mac, investment banks, Bear Stearns, Lehman Brothers are only few examples of many bankruptcies or financial institutions that had to be bailed out. The too big to fail reputation was under heavy scrutiny. This resulted in a public feeling of distrust. Since trust is actually the foundation of banking, a general feeling of distrust is therefore troublesome. The reason being the following. Suppose I go to the bank and I put 100 euros in my bank account. I'm confident that whenever I need my 100 euros, I can go and withdraw it as cash, or I can go to the shop and buy new shoes with my debit card. The bank gives me a 1% interest rate, and this is actually an incentive to keep my money in the bank and not in cash. From a bank's perspective, they are required to keep 5% as a capital reserve according to Basel regulations, this resulting in 95% being freely available to invest or give out as a loan to other people. This is fundamentally and in a nutshell how a bank makes their money. However, when someone doesn't have a big trust in his bank, he would have a strong incentive to withdraw their money. Now the problem is the bank only has 5 euros since the other 95 are stuck up in an investment. So this results that the bank wouldn't be able to give me back my 100 euros. If this happens on a macroeconomic level, the banks will soon become insolvent and they will run out of liquidity. A run on the banks is a situation when people lose their confidence in the stability of a bank and rush to withdraw their money. We can see this happening in Greece, or in the time this happened to Lehman Brothers. This also actually accelerated their bankruptcy. We can also see a public feeling of distrust being troublesome in the financial institutions, since acquiring new clients would be 10 times harder. The second challenge is the conduct of business under tighter regulation, paired with higher costs resulted from regulatory compliance. Now, the task of the regulator is to ensure the stability of the whole economic system. And since the impact of the credit crisis was so disastrous, the regulator had to take action. Now, this action meant that a lot of financial institutions were subjected to a lot of restrictions. Restrictions on the portfolio of assets a bank can hold, reserve requirements, capital buffers, specific M&A rules are only few examples of restrictions that were imposed. Of course, Basel III being the most known. The challenge is to incorporate regulatory compliance in every branch of the bank and in a broad sense incorporate it into the business model of the bank. The challenge is also to have a well-functioning and innovative compliance department. This task, however, is not easy, but the payoff is high, since it will enable banks to cut costs, boost efficiency, and enable them to have higher profits. The third challenge is what I like to call the unknown. In university, we learn economics by studying models which enable us to understand what is happening. However, we're now going towards a state that we haven't seen or experienced before. We have macroeconomic factors such as low interest rates, even negative interest rates, low inflation. On the other hand, we have a global slowdown of economies along with decreasing commodity prices, and also worth mentioning the rise of populistic parties. All these factors have an influence on the financial landscape. And since all these factors are happening simultaneously, we're heading towards a state that we haven't seen or experienced before. I want to attend the Masters in Finance at IE Business School to gain insight and knowledge about the financial service industry. In a broad sense, I'm hoping to play the role of an innovative, responsible, and integral leader. As an individual, I stand for cultural, social, and environmental awareness, along with innovation, integrity, and last but not least, diversity. I want to contribute to the success of my future employer, and last but not least, I want to make this world a better place.